I am AI Avatar of CA Ratan Mundra. The International Financial Services Centres Authority, or IFSCA, has issued an important circular on 27 January 2026, providing a one-time window to extend the validity of placement memorandums, also known as PPMs. This regulatory relief is aimed at venture capital schemes and restricted schemes operating in IFSCs, especially those impacted by fundraising timelines and market conditions. In this video, we will explain who is eligible, the conditions, the process, applicable fees, and a validity period under this one-time extension window. Under the IFSCA Fund Management Regulations 2025, the placement memorandum of a venture capital scheme or a restricted scheme is valid for 12 months from the date it is taken on record by the authority. Additionally, for open-ended restricted schemes, investment activity may begin after raising $1 million, but such schemes must reach a minimum corpus of $3 million within 12 months from the PPM approval date. IFSCA received several representations from market participants highlighting that fundraising timelines are often dependent on market conditions and beyond the control of fund managers. After examination, and alongside the upcoming Fund Management Amendment Regulations 2026, the authority has decided to provide temporary regulatory flexibility through a one-time extension window. Accordingly, IFSCA has opened a one-time window of 3 months from the date of the circular. This window allows eligible venture capital schemes and restricted schemes to extend the validity of their placement memorandums subject to specified conditions. This category covers venture capital schemes and restricted schemes where investment activities have not yet commenced. If the PPM has already expired or is set to expire on or before, or within 30 days of the notification of the upcoming amendment regulations, such schemes may apply for extension under this one-time window. To avail this extension, the fund management entity must refile the placement memorandum within 3 months from the date of the circular, clearly stating that the extension is sought under the one-time window. Importantly, no material changes are permitted in key aspects of the scheme, such as its name, investment objective, strategy, structure, or scheme category. The refiling must be accompanied by a fee equal to 50% of the fee applicable for filing a fresh scheme under the fund management regulations. Once the authority is satisfied with the compliance of these conditions, it may take the refiled PPM on record. The validity of the PPM will then be extended by an additional 6 months, starting from the date the authority communicates its approval. The circular also provides relief to open-ended restricted schemes that have already commenced investments after raising $1 million but were unable to achieve the minimum corpus of $3 million within the original or extended validity period of the PPM. If such PPMs have expired or are set to expire within the specified timeline, these schemes may also seek extension under the one-time window. The fund management entity must submit a formal request to the authority within 3 months from the date of issuance of the circular, clearly stating its intent to seek extension under the one-time window. This request must also be accompanied by a fee equal to 50% of the applicable fresh scheme filing fee. The fund management entity must submit a formal request to the authority within 3 months from the date of issuance of the circular, clearly stating its intent to seek extension under the one-time window. This request must also be accompanied by a fee equal to 50% of the applicable fresh scheme filing fee. Upon approval, the extension granted to such schemes will be deemed to commence from the date on which the PPM had expired or was set to expire, ensuring continuity in regulatory compliance. Schemes that avail this one-time extension may still seek further extensions beyond 6 months, strictly in accordance with the provisions of the Fund Management Regulations. Such extensions will remain subject to the payment of 50% of the applicable fresh scheme filing fee as prevailing at that time. This circular has been issued under the powers conferred by the International Financial Services Centres Authority Act 2019, read with the relevant provisions of the Fund Management Regulations, and comes into force with immediate effect. To conclude, this one-time window provides a time-bound and conditional opportunity for fund managers in IFSCs to extend the validity of their placement memorandums amid challenging fundraising conditions. Eligible entities should carefully assess their status and ensure timely compliance within the 3-month window to benefit from this regulatory relief. Moonsys and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support and handling complaints, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BAT, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.